John Persinos, Editorial Director of Investing Daily, with a video presentation for Friday, June 18. Stocks have been rallying since November, but don't get complacent. Inflation, an increasingly hawkish Fed, and excessive stock valuations pose risks. In today's video, I'll quickly outline protective measures to take now. Since the beginning of 2021, stocks, bonds, and just about any investment you can think of have gyrated wildly at various times amid concerns of inflation and the possibility that the U.S. equity market is overvalued and maybe headed for a correction. Whether inflationary increases turn out to be transitory or more permanent, you should fortify your portfolio. If you've ever thought of certain investments as insurance, now's the time to start increasing your exposure to them. Protecting wealth is as important as building wealth. Let's step back from the daily ups and downs of the markets to examine 3 ways to safeguard your investments from current threats. But first, I want to consider the cyclically adjusted price-to-earnings ratio, known as CAPE. The widely respected Professor Robert Shiller at Yale University invented the CAPE ratio, also known as the Shiller PE, to provide a deeper context for market valuation. The CAPE ratio is defined as price divided by the average of 10 years of earnings, the moving average, adjusted for inflation. Take a look at the following chart. The ratio currently stands at 37.46, which is 136.6% higher than the historical mean of 15.83. According to this long-term chart of the CAPE ratio, stocks in the S&P 500 are more excessively valued than they were in the fateful years of 1929 or 1987. If the stock market does suffer some sort of correction, there are only a few investments by which investors will be able to preserve their wealth. Let's take a look at 3 of them. The Federal Reserve this week made it clear that it's beginning to think about rate hikes, which means the central bank does believe inflation will be on the increase in the coming years. This should come as no surprise because the central bank has actually been encouraging inflation through its stimulus program and accommodative policy. The following chart shows the massive increase in the Fed's balance sheet this year. According to data, as of June 9, the Fed's balance sheet approaches $8 trillion. Anyone who understands that the Federal Reserve is willfully attempting to create inflation through stimulus and also understands history knows that central banks are terrible at timing rates. Rate hikes tend to kill bull markets. That's why investors should view any drops in the price of gold as an opportunity to buy cheap insurance. Historically, gold has been the calm in the storm of volatility. Beyond gold, agricultural commodities make an effective hedge. The next geopolitical struggle could be over food. The world is consuming more food than it produces, largely because of population growth, rising affluence in developing nations, and extreme weather in major food exporting countries. Poverty-fighting organizations such as Oxfam predict that the price of key staples, including wheat and rice, could double over the next 2 decades. Take a look at the 3rd chart. If you're risk-averse and seek safer and easier plays in agriculture, consider exchange-traded funds, ETFs. Agricultural ETF portfolios invest in grain and feed products, oilseeds, cotton, corn, wheat, soybeans, cocoa, coffee, sugar, dairy, livestock, poultry, and or horticultural products. These funds can invest directly in physical assets, the equities of major agribusinesses, or commodity-linked futures contracts. Finally, don't forget about TIPS, a proven inflation protection tool are U.S. Treasury inflation-protected securities, known as TIPS. TIPS are tied to the CPI. When the CPI goes up, the principal values of TIPS rise too. Investors are increasingly scooping up TIPS, recent data compiled by Bloomberg show. Fueling the buying frenzy are worries that inflation protection could become prohibitively expensive as the price of these instruments are bid higher. In addition to low-cost tips, I recommend that your inflation protection strategy includes a diversified mix of commodity and real estate stocks, as well as emerging markets exposure. By increasing your stake in developing economies, you're protecting your assets from the risk of a U.S.-centric versus global inflation shock. Okay, that's it for now. If you want to reach me, I'm easy to reach. Just send an email to mailbag@investingdaily. Thanks for watching. Please stay safe and stay invested.